Anil, thank you for the introduction, and on everyone, welcome to today. I'm going to talk to you about the Nedgroup Flexible Income Fund and give you a bit of an overview of what we've done and also what we're seeing. The title of the talk this morning was Deja Vu. We sometimes struggle to find, new titles, but I think this quarter it was easier. Because it does feel like quarter three was a repeat of second quarter, where we saw a lot of volatility and again inflation surprising to the upside. If you look at the performance of the fund over 1 year, I think quite pleasing for us. It's been difficult market conditions, but a gross return of 5.7%, achieving slightly better than money market returns. But as I've said, tough market conditions. If you look at the composition of that return, you can see that over 1 year, inflation-linked bonds doing fairly well for us, giving us 1% over the year contribution to that return. Floating rate notes, a nice contribution. A lower return from our nominal bond component. Again, it's been a tough year and a tough kind of 6 months for duration assets. All in all, I think fairly pleasing. But as I tell all my colleagues, as we know, the challenge is always forward-looking, and you can't look in the rearview mirror for too long. Quickly on our approach, and as you've seen in the previous slide, I think we have a diversified stream of returns. So we believe, diversification is quite important. We follow a diversified alpha approach in this fund. So what we are looking for is, these different sources, diversifying sources of fixed income returns. As you can see from that side, we look at normal nominal bonds, inflation-linked bonds, convertible bonds, credit. We look at currency and the likes. We look at these things in our local market, but also in the offshore market. And I think having the ability to look at offshore assets is a nice diversifier. And ultimately, having this diversified approach, limit a drawdown to any single asset or asset class. So our job is to try and determine which of these are a bit more expensive and hopefully tilted to what we perceive as cheaper assets. I'm going to start now with giving you a bit of a global backdrop, and I think a lot of these you would know fairly well. But we'll start with, I think, what's been dominating the markets, the last, I want to say 6 months. It's probably been a bit longer than that. Well, firstly, you had, the invasion of Ukraine, which played havoc to markets in, the first Q1, Q2. But I think more surprisingly is if you look at that left-hand slide, and that is the implied US terminal rates. Now, at the bottom, you can see there it looks like slightly bluish. In March, the terminal rate was about 2.5. Then you go to June, and people thought the terminal rate is going to be around about 3 in the US. You come October, and that terminal rate shot up to 4.5% on the back of persistent inflation and inflation surprises. Now, I think all of that is now more or less discounted in the market. But the other interesting thing for me is that you've got a Fed that's got, a team of PhDs and economists and some of the most, I think, best economists around, and no one got this right. So for me, I think there's also a lesson in some of this. I think forecasting these things are exceptionally difficult. And I think that's an important point, especially from an investment point of view, when you're trying to, I think what I'm saying is trying to forecast some of these macro variables are very difficult. And then we move on to the next slide is, I just looked at the market the last couple of days. The market is hoping and praying for a pivot. If you look at the FOMC members, the dot plot at the end for their projections for the end of 2023, you can see only one member of the Fed is seeing a terminal rate at the end of 23 at about below 4%. Most of the participants see at around about 4.5%. And I think the key takeaway here is, don't wish, or I think it's wishful thinking if you're waiting for a pivot anytime soon, and especially with the persistent inflation that we've seen from the market. Now, I'm not an economist, but I'll give you a quick overview just of some of the inflation that we're seeing. If you could look at US inflation, it does seem like core goods, core inflation, has surprised to the upside. We do believe core goods have rolled over, and we should see some relief from that. But I think now where we're seeing some stickiness is core services. And part of core services, if you look at it, is probably more aligned to the labor market. So in the US, we've got a tight labor market. And you can see there on the right-hand slide on the US non-farm payrolls, that is still printing above 200,000. Interesting fact, you rewind a couple of months ago, you were seeing that there was 2 job openings for every a person, wanting a job or if that's in the labor market. That's now come down to a 1.7. So you are seeing that, job openings and companies are scaling a little bit back on that. But it's still a very tight labor market in the US. On the back of, they still got some reasonable growth. However, I do think we have seen, you look at the housing market, we are seeing some data that's coming in a bit softer, but to some extent as expected. Now, I think the rally we've seen the last couple of days is, again, I think, I don't know what the catalyst was. Maybe it was some of the housing data, but the market definitely looking for some sort of pivot and hopefully see an end to some of this volatility that we've seen. We go back to the rand, but it's not so much been a rand story, it's actually been more a dollar story. And you can see there on the left-hand side, the Dixie, the dollar index, where it's now at, highs that we haven't seen for a decade or two. And like one of my colleagues said, if you look at across developed markets, I think there's a lot of issues. We don't even have to go into the Eurozone with some of their issues. And then you've got the UK that we thought is fairly developed, and you look at some of the rookie mistakes they made the last month or so. So, like one of my colleagues said, maybe the US is just at this point in time the tallest dwarf, the tallest dwarf of them all, but backed by still fairly robust underlying growth. The US have obviously raised their rates quite aggressively, and still a decent labor market. So, all in all, I think that's led to appreciation in the dollar. There's some risk-off sentiment, of course, but obviously the dollar is doing exceptionally well on the back of this. So it's been a dollar story, and if you see, a bit of our view on the rand has not been that weak relative to trading partners, except, of course, the US dollar. So what we have here, we look at the fair value for the rand, and we see the rand at the moment at our compared to our trading partners as slightly on the cheap side. But I think the takeaway here is more dollar strength story the last couple of probably the last year or so. So that's a bit of a global backdrop. We're going to move into a global onto local rates, and I think what's interesting here, if you look at our FRA curve, is pricing in quite a few rate hikes. We've got the next meeting coming up in a couple of weeks. We are seeing a rate hike of ballpark about 75 basis points, which will take us to 7%. If you look at where our SARB members see the real policy rate, which is probably 1.5 to probably 2%, it means that our neutral rate is around about 7.5%. So I think the SARB wants to get us as quickly as possible to some sort of neutral rate, and then hopefully it will give them a bit of time to assess what the Fed is doing. Because if global inflation keeps on being sticky, I think we have very little option but to some extent follow the Fed. So hopefully we do see a bit of softening on US data. So when our rates get to 7.5, hopefully the SARB can look at more of our local dynamics, because we don't have a supply-driven inflation issue at all. We can just look at the inhibiting effect of load shedding that we have on growth. If you look at then inflation on the right-hand side, you can see there, inflation, headline inflation has probably peaked at about I think it was about 7.8% in June, it seems now. But the concern would there be, you can see their core inflation still heading up a bit. So we don't think we've got an inflation problem. So hopefully rates will go up, but not as high as the market and our FRA curve is expecting. We move on to our yield curve. And you can see there we've just looked at the components that we like to look at when we look at fair value for our local bonds. The input there would be a US real of 1.5, an inflation assumption of 5%, a small inflation risk premium. And then you look at the current 10-year yield, and from there you can imply a country risk premium. And if you do that, back calculated, it's about 4.4%. We see fair value around about 4%. So local bonds, we believe, are on the cheaper side. But however, what has happened the last couple of months, I think on a relative basis, it's actually become slightly less cheap, or if you want to say a bit more expensive. And that's on the back of higher US real rates. If you look at the graph, you can see there the US real rates, and it's shot up significantly. It's put a pressure on a lot of assets, on a lot of asset classes, all high duration assets, whether it be bonds or high growth stocks, fell the brunt of this. But the message here is we do believe that if you look at global fixed income, more specifically US fixed income, I think there is some value to be had there at this point. If you look at the US 10-year yield, the real yield of 1.5, if you look 40, 50, 60 years, the realized real return has been closer to 1%. So we do think if you look at both US bonds and local bonds, that on an absolute level, both are actually attractive. So yes, we, from a global fixed income perspective, is looking a lot more interesting than it was, let's say, a year ago. On the MTBPS, I think I'm going to leave that to my much more better informed colleagues. What I can say is I think we've seen better numbers than consensus. I'm just showing you there's some treasury numbers in the 2022 budget and some consensus numbers. So you look at the budget deficit, that came out at 4.9. And you look at end of 23-4 and 24-25, those numbers I think now is, by yesterday came out at 4.1 and 3.7. So nice revenue overruns. I think they've allocated that overruns wisely. Our debt to GDP on the right-hand side, you can now see they're seeing at peaking at about 71.4%. I think the one concern for us would be, and the disappointment is that the Eskom debt situation was not addressed. We were hoping for some more clarity on that. So I think the key takeaway from us here was that fiscal consolidation, there's a commitment to that. We are, however, slightly concerned about some of the expenditure items that hasn't been fully addressed, which include, the SDR grant, Eskom, and some of the wage increases. So all in all, I think quite a reasonable MTBPS yesterday. And we've got a couple of minutes left. I'm quickly going to go into the portfolio, and this is more the practical side. If you look at the yield pickup of the fund versus, STEFI or kind of a money market yield, quite a nice pickup of well over 2% relative to cash. So we've done a lot of work to enhance the yield of the fund. We've also seen quite a few opportunities the last couple of months in the market, which we've, you never take advantage. In hindsight, you never do enough. It's just the way it goes. But I think we've had some nice, interesting opportunities that we've used the last couple of months. And that's why you've got a fund yield of over 8%. In addition to that, we do believe if you look at how assets are priced, that there is some scope for capital appreciation in this fund over the medium term. So I think just purely from a prospective point of view, I think in a lot better position. If you look at the fund positioning, obviously we try and focus on diversification, focus on if we can get some diversified, cheaper assets, high degree of credit quality. And we do believe that we're at a point where we've seen some, exaggerated inflation concerns. The one concern might be that, we're still underestimating how sticky global inflation is going to be. But that's a topic for another day. So at the moment, we've got a fund yield of 8.2%, total duration of 1.3, which is dominated by local bonds at about 0.9. And then we've got a 0.2 inflation-linked bond duration and 0.2 on offshore bonds. I think offshore bonds is the one interesting thing where we've seen quite a few opportunities. You rewind a year ago, very little that we wanted to invest in. we've been, to some extent, spoiled for choice the last couple of months. So a lot more interesting on the offshore side. If you look at the makeup of the fund, lowish in property at 2%, a big floating rate component that will reset higher, so that will increase the yield of the fund. We've got some inflation-linked bonds, nominal bonds. So all in all, a nicely diversified portfolio. Our total offshore exposure now is over 20%. However, our currency exposure is just over 3%. So, currency is actually a decision that you take separately from your offshore assets. So all in all, happy with where we are at the moment, and I think the fund is set up for a nice year going forward. Thank you for your time. I'm now going to give over to Rashad Tayob.